Hello and welcome to the Providence Investment Update for April 2026. My name is Michael Ogg and I'm joined here today by Marc Wait, Chief Investment Officer at Providence. Welcome, Marc.
Thanks, Mike.
Marc, I'll go straight to the title of the GOS, the Global Outlook and Strategy, Testing the Foundations. Talk us through what the foundations are, why they're being tested and why that theme's relevant right now.
Absolutely. So I think there's been a bit of a thematic in terms of how we've been thinking about global economies and most importantly markets. And after Liberation Day last year, we came up with a title which was Solid Foundations. And I think what we're really doing there was saying, yes, there was some ructions around markets and economies around those big increases in tariffs, but the underlying foundations were quite solid, and that's important. So, and what do we mean by that? Support from monetary policy being slightly eased, we had support from fiscal policy, we had reasonable sort of pickup in earnings growth, low unemployment, and all of these things meant that there was some supportive factors for markets as we sort of look forward. And if we think about what's just happened in the most recent quarter, in terms of the geopolitical activity that's happened, that's obviously sort of tested those foundations. But we wouldn't say that's shaken them, we'd just say it's tested them. And that's why we've come up with that title.
And just taking the geopolitics, it has been a very turbulent quarter and geopolitics has been absolutely front and centre, as we know. So what actually has unfolded over the last couple of months and how's the market reacted to it?
I mean, it's been a remarkable quarter. So if you think about how we started the year, it began with a sort of toppling of a leader of a country in terms of Venezuela, where that leader was taken with his wife to the US for charges, quite a sort of momentous occasion. And that led to sort of a big decline in oil prices, which was quite interesting. Oil prices moved below $60 a barrel. And then after that, there was some musings from the Trump administration around the need to sort of take over Greenland, and that kind of really caught the market's attention quite a lot. And then as we sort of came into the end of February, we had the start of Gulf War III, and that's obviously been a momentous environment. And if you think about it just through the lens of the oil price had touched 60 in that sort of January period and moved all the way up to 120 in terms of the Brent crude oil price. And then it's come back a little bit recently. So some really big sort of events there. And they've been important for markets because they've created a lot of uncertainty.
And stepping back for the headlines for a second, how has that reshaped the outlook for the economic growth and inflation and what really matters for investors at the moment?
Yeah, so really important. And it comes back to our view of what are the foundations. And so we spent a lot of time as these events unfold to want to see what do we think are some scenarios that might impact real economic growth, inflation, what might the risk to company earnings be, and how might there be a reaction function around there. And the pleasing thing was it's really about duration. And so the duration of Gulf War III is really important. And if we can get to an environment where things start to settle down and we open up the oil traffic through the Straits of Hormuz as we sort of get to the middle of the year, a lot of the scenarios are reasonable. So essentially what it is you started the year with a strong period for economic growth that's been marked down. But for global GDP, most economists are still thinking 3%, emerging markets closer to 4%, developed countries like Australia, the US and New Zealand at 2%, and then some weaker countries like Europe at sort of around about 1%. What has changed though is that sort of mix between growth and inflation. And so there's definitely a one-time price increase from the increase in oil. If we do get a resolution and oil starts to flow, the expectations are that the oil price starts to move back towards $80 a barrel. And that's an interesting sort of environment, interesting sort of cocktail, but not something that breaks things.
And just moving to central banks for a moment. I mean, central banks were quite accommodative last year in talking about cuts. That has changed somewhat. Can you just talk about that?
Yeah, so that's a really critical piece of what's happened. And I think there were expectations from a number of central banks outside of Australia that policy was going to be eased. And you can really split it into two camps. You can split it into those central banks that have either got an existing inflation problem, like the Reserve Bank of Australia, where there's now expectations that they'll continue to hike probably at least another 2 times, if not 3 times in terms of the forward curve. You've got other economies that weren't expected to move rates, which are now seen to move rates, like the UK and Europe, where the market's pricing around about 50 basis points. And those central banks are really sort of very focused on inflation as their sort of central beacon, their central target. Then you've got other central banks, like the US Federal Reserve, which have a dual mandate. And so the dual mandate focuses on both inflation and unemployment. And in that environment, what we've seen is we've seen a little bit of a paring back in terms of expectations of a near-term easing in policy from the central bank because of worries about the employment market, to have a more of a sort of a neutral stance. But I think the bias of most forecasters is that over time, the Fed will be in a position to ease rates.
Okay. And Mark, sort of taking that, and then what's the implication for markets? When I say markets, I mean talk about equity markets, credit markets, bond markets. So what are the implications, and what are investors missing at the moment?
Yeah, so I think there's some really interesting opportunities at the moment. And if you think about what the implications are for markets and what's been going on across all of the different markets, equity markets have been really interesting. So if you look at the sort of peaks for the year that we saw in late January, February, we essentially saw most markets move into a correction territory, whether that be the S&P 500, whether that be emerging market equities, whether it be sort of Australian equities. And that, well, by correction, what do we mean? We mean down 10%. But then quite swiftly, people have really done a lot of the work like we did and looked at it and saw that you've got a window where it could be reasonable, and earnings are still quite strong. So you've actually seen quite a good bounce off the lows that we saw in March, and the markets have moved back up, which I think is quite interesting. The second thing is, if you look at bond markets and monetary policy expectations, we touched on that previously. So bond markets have become a little bit more worried about the path of monetary policy and also the path around short-term inflation. But it's really important to draw the point that they're not really that worried about longer-term inflation. So if you believe the implications in the bond market, the sort of break-even inflation rates are still at a manageable level, and the real yields are quite attractive when you go out to the 10-year part of the curve. In a market like Australia, you're now getting real yields above 2%, and the sort of nominal yield for Australian government bonds on the 10-year part of the curve is touching 5%. So that's a really interesting period, interesting environment. Credit markets had a beta, a little bit like equities. They were also sort of, there'd been a period of time where people would start to question the sort of software capital light business model. And we'd seen a pretty big correction in software stocks, and that didn't start in the beginning of the year. That started around about September last year. So that particular sector of the market was down about 38%. So you did get some pressure in the credit markets. As we've always said with credit, it's really important to focus on the quality of the manager, the quality of the credit work. And pleasingly, what we've seen with our managers is we've seen quite a good bounce in terms of the credit markets and those underlying portfolios, as some of those fears around redemptions and other things like that have started to dissipate. And there was actually some quite good value in the credit markets as we saw that maximum fear. And I think our sort of often quoted person, Howard Marks, had really sort of pointed out about the opportunities that get presented in credit markets when you have this sort of maximum skepticism, maximum fear. The other asset class, which I think has been really solid as a rock and has really been an important part of our portfolio mix, has been infrastructure. And so infrastructure is quite remarkable at this point in time. You kind of think of it as an asset class that's quite sleepy. If you look at a subset of it like utilities, for the S&P 500, the utilities sector is expected to have earnings growth of 10% per annum for the next 3 years, which is quite a remarkable number for an asset class like that. And that's really around things like the energy transition, the demand for energy from data centres, and just a really interesting path for growth in that period. And that asset class has really gone through a bit of a re-rating during that period and seen as a really defensive asset to defend against some of that higher inflation, and also as more and more attractive as a replacement value for a lot of those assets has gone up.
And Mark, I mean, if you can pull it all together, what does that mean? What are the implications for portfolios? Are you making any changes? How's that looking with a view of the next 3 to 6 months?
Yeah, so I mean, I think in terms of our stance, it's really important to understand what our starting stance is. So starting stance is that we've been positive on growth, and we've been going through a period which we termed as passing the baton. So we felt as though capital will flow to where it's most welcome. And in equity space, that's really where valuations are attractive, where earnings are attractive. And so we've really sort of moved to a position where we've had a position in US equities, but we've actually had an overweight outside of the US and underweight US equities. So we really like the story in Japan. We continue to think that's got some good legs, particularly with our activist manager in there. Emerging markets, we feel as though we've turned the corner after a pretty hard period from that sort of 2012 period onwards until around about 2023, and we think the valuations there are attractive, sort of 12 times forward earnings, earnings growth similar to the US S&P, and then also mid-cap space. We think that space is somewhere where it's going to start to bounce. So that's been a really important part of how we've constructed, and that's provided some really solid outperformance. If you look at the sort of structure of our equity portfolios compared to just owning the index, the outperformance has been around about 5% since the start of the financial year. So that's been really pleasing about how that's weathered that storm, has done well. The other area we talked about before was infrastructure. So that's been moving well, both in sort of public and private space. We've also sort of looked at recently, we've made some adjustments in terms of our alternative managers. So we appointed basically a multi-strategy hedge fund, which is quite liquid. And so that's been a good addition to provide some diversifying characteristics within the portfolio. And then in terms of gold, we've talked about gold a lot during our podcast, and that had become quite a big position in our portfolio. It's very deliberate, a hedge against inflation, a hedge against geopolitical ructions. And we took the opportunity to reduce our position in that pretty substantially. So we took it down from 8 to 2.5%. So it was goodbye to a large allocation to gold, but not farewell. We've kept a little bit within portfolios. And then more recently, we've just taken the view that we think some of those yields, particularly in the government bond space and Australian government bond space, are pretty attractive. So we're starting to move back from a pretty underweight position there and taking advantage of those sort of high real yields within the portfolios. So there's been some really interesting things going on in the portfolios, and I think most importantly is while some of the things we've been doing at the margin, we've actually been really pleased about the resilience of the portfolios, very true to label, true to the DNA of Providence around the protection and preservation of capital.
Thank you, Mark. Thank you very much for your insights.
My pleasure, Mike.
And thank you for watching. I hope you enjoyed the discussion. If you do have any questions on any themes or anything that's come up in this conversation, please don't hesitate calling us at Providence. Until next quarter, see you then. Thank you.